So, Brian, as I was saying, or trying to wrap up the previous segment, it's basically, over the past, well, since the financial crisis, you had the Fed at your back, right? I mean, there's so many stocks and so many different sectors you could buy, and the majority of them went up. We're in a much different environment now. You actually have to do your homework and figure out what stocks are going to go up and which ones are not because they've got their own, issues. Wouldn't you agree? I mean, it's actually a more interesting time to invest.
Well, yeah, it's more gratifying for people who are wired to do fundamental research, as my colleagues and I are here at First Avenue Investment Counsel. It's kind of frustrating when you see markets where, the Uber driver and the delivery boy is an expert, and the meme stocks are going up 300% a day, as we saw 4 or 5 quarters ago. And you're right, that's a function of free money sloshing around the system. You point to the Federal Reserve and the Bank of Canada with the liquidity taps wide open. That was indeed the case, and that floated a lot of risky assets, that weren't backed by solid fundamentals. The other thing too was COVID and federal largesse, both in Canada and the United States. There was a lot of money in sort of consumers' pockets that wasn't necessarily earned, but just came in the mail via check every month, and a lot of the service sector of the economy was slammed shut, right? COVID lockdowns were pretty slow to lapse here in Toronto and in Canada in general. And so I think people that might have otherwise gone to sporting events and concerts and casinos, made their own casino in the stock market. And so that has shifted 180 degrees. The free money from the government has been shut off. And the central banks are tightening the purse strings as well. We've seen very aggressive rate hiking campaigns on both sides of the border. There's more in store. And so, now you do have to do your homework. And so, what we are looking for are companies that cater to consumers' needs, not their wants, because in an environment where you can't have everything, which is 2022, unlike 2021, needs get
Yeah.
prioritized and wants go by the wayside.
Yeah, I mean, it is amazing the demand for, as you say, jet skis and hot tubs. I mean, we were all at home, right? So everybody wanted something fun in their household. That's for sure. I know we bought a hot tub anyway.
Well, and I'm
So
sure it gets a lot of use. So these are good things, and they're durables, right? So you buy one and it lasts for 10 years or more, and so a lot of that demand got pulled forward for these hardline
yeah,
durables, and it created windfall earnings for a lot of manufacturers and retailers of these kinds of you know stay-at-home things like Pelotons and hot tubs and what have you.
yeah, that's right. Well, let's talk about that. It's interesting. So we're really going to be looking at stocks that people need their products. So one that you're looking at. Let's talk about the dollar stores. So Dollarama and Dollar General. So one Canadian, one US.
Yeah, that's right. So Dollarama, for viewers, I'm sure everybody knows this retailer. It's ubiquitous in Canada. It almost defines the dollar store category here, with about 14 or 1500 stores across the country. It's been public since about 2008, and it's just created tremendous shareholder value. It's up 8 or 10 fold since the IPO. And it grows earnings through thick and thin at sort of a low teens to mid teens clip, led by 5 or 6% growth on the top line. That's driven by same store sales growth. They continue to find new ways to merchandise the store, new things to sell you. They add price points periodically, so it's no longer just a dollar store, but there's stuff all the way up to $4 and I think $5 now. And then they're opening new stores because the concept is not saturated across the country to the same extent it may be in the United States. They have operating leverage and they're very free cash flow generative, so they buy back their shares, and it all rolls up to a nice mid-teens growth rate. We think the shares are just a secular winner and undemanding valuation, about 26 times earnings. And indeed, they have been doing very well this year and are up 20, 25%, 30% year to date. So,
Wow.
we added it back earlier in the year and continue to like it. And then
26 times. I
stateside,
mean, that's a lot for a dollar store.
well, no, it's in line with where this company has traded historically. It gets a premium relative to other retailers because it grows more quickly and it's really got the category almost entirely to itself. Now, if you look to Dollar General in the United States, it's the leader in the US dollar store sector. It trades at 22 times because it's not as profitable as Dollarama, and it's got more competition, and it competes in tougher categories like grocery, where Dollarama doesn't really play. So they have different business mixes, but thematically they're on that trade down theme.